Welcome to PIMCO Pod. In this episode, we discuss public debt in developed countries and what it means for investors. Stay tuned after the conclusion of the podcast for additional important information. Developed Market Public Debt, A Long Road Ahead, by Peter Beck-Friis. Bond investors assess many factors when weighing portfolio decisions, and this year, global fiscal policy has drawn close scrutiny. On the surface, much seems to have changed. Germany has loosened its fiscal rules and on Tuesday set out an expansionary budget for the year ahead. Many European countries have announced plans to boost military spending. As of this writing, it appears likely NATO members, meeting this week at their annual summit, will commit to raising defense-related spending to 5% of GDP within a decade. In the U.S., the tax and spending bill advocated by the Trump administration is moving through Congress, and Moody's has joined the two other major rating agencies in downgrading the long-term U.S. credit rating. Markets have responded by pricing in higher-term premiums on long-dated bonds, steepening the yield curve. Uncertainty has increased, driving bouts of market volatility. Yet the bigger picture for public debt remains much the same as last year. See our latest PM chart book for details. Deficits will likely stay above pre-pandemic levels, partly due to rising borrowing costs. And although fiscal policy in some countries may be less tight than expected a year ago, we do not expect a big fiscal splurge ahead. The fiscal outlook in the developed world looks broadly neutral, neither stimulative nor contractionary, and so is unlikely to be a major driver of global growth, unlike during the pandemic years. Debt dynamics, meanwhile, still appear fragile in a few countries, perhaps more so than before. But these issues seem chronic, not acute, unlikely to trigger a sudden fiscal crisis. Instead, we expect episodic market volatility, possible further steepening of the yield curve, and governments to eventually address deficits via tighter fiscal policies. Deficits on average hold steady. Fiscal deficits vary widely by country, but in aggregate across developed economies, look set to stay roughly flat in the coming years, barring a recession. Many recent easing measures simply offset earlier plans to tighten budgets. In countries with limited fiscal space, higher military spending will likely be balanced by cuts elsewhere or higher taxes. The UK's recent cut to foreign aid to fund defense spending is a clear example. Many euro area countries have so far avoided borrowing more for military boosts, even though the European Commission has relaxed its fiscal rules to allow it. Deficit dynamics and fiscal approaches vary across countries. The Trump administration's fiscal package, in whatever final form it takes after congressional wrangling, will likely keep the U.S. structural deficit around 6% to 7% of GDP, roughly the same as it is today. In the euro area, the overall deficit will likely stay steady too. Germany looks set to ease, and its deficit may reach around 4% of GDP in the coming years. However, EU countries with tighter limits, including Italy, Spain, and France, are likely to tighten, and EU pandemic support will phase out. Elsewhere, Japan may ease fiscal policy slightly, but the UK appears set to tighten. The long road of public debt. Near-term deficits may be stable more or less, but government debt sustainability over the long run is more concerning, and investors are taking note. Government debt has been rising for decades, and many countries have been on an unsustainable path for years. The facts remain stark. Today, G7 government debt hovers near the peak levels seen after World War II, highlighting the dramatic scale of public borrowing. Start with the good news. In most countries, debt is not a pressing concern. Most euro area countries, and also the Nordics, Australia, New Zealand, and Switzerland, have debt levels too low to threaten fiscal credibility. A few, like the UK and Italy, face a more fragile outlook, but their debt looks broadly sustainable if they follow through on planned fiscal tightening. Meanwhile, Japan's debt remains very high, but is unlikely to rise much. Japan still borrows at low interest rates relative to GDP growth, making its debt easier to manage. 3 countries stand out: the U.S., France, and Belgium, where debt is on an ever-increasing path under current policies. All run large primary deficits, ignoring interest costs, and borrow at interest rates at or just above their normal growth rates, compounding the cost of servicing those deficits. and none plans to tighten policy meaningfully soon. At some stage, however, policy or prices must adjust in order to temper the rising debt levels. The best-case scenario is if growth picks up, expanding the tax base and stabilizing the debt ratio. A more disruptive scenario is if policymakers resort to high inflation to erode the nominal value of the debt stock. Neither seems likely. Growth looks weak. For the U.S. to flatten its debt curve, trend growth would likely need to exceed 4% over time. Unlikely, even for AI optimists. Central banks might tolerate slightly higher inflation for a while, but likely won't let inflation expectations rise much. After World War II, high inflation, together with financial repression, anchoring yields artificially low, helped reduce debt. Today, central banks have stronger credibility, with long-term inflation expectations anchored near targets. Instead, the most likely long-term fix is debt consolidation through spending cuts or higher taxes. This may seem unlikely now, but attitudes could change over time, perhaps beyond the next 5 years, especially if interest rates stay high or rise with a higher term premium. The UK's experience after Prime Minister Liz Truss in 2022, shifting to a tight fiscal outlook after a temporary spike in yields, serves as an example. But a policy pivot doesn't require a sudden jump in term premia. Over the last century, the U.S. often tightened policy when high rates constrained fiscal policy or growth. Interest payments now make up nearly 14% of U.S. fiscal spending and are rising fast. Previous times when interest costs hit similar levels were followed by fiscal consolidation. After World War II, with financial repression as well, under Reagan in the late 1980s, and under Clinton in the 1990s. Market implications. With debt and deficits high, market volatility will likely continue. High deficits will keep bond issuance elevated in coming years, and when government debt climbs, investors tend to demand higher compensation to hold long-term bonds instead of cash or short-term bills. With deficits already high, future downturns will likely push them to historically high levels. This may limit active fiscal easing during recessions, shifting more burden to central banks. Before the pandemic, when interest rates were low, fiscal space was ample and monetary policy space limited. Now, when interest rates are higher, fiscal space is limited and monetary policy space ample. That makes front-end rates more attractive. These trends raise the risk of steeper yield curves, and investors should consider positioning for this scenario. We also see value in global diversification. Different fiscal situations across countries create opportunities for relative value in global duration. Thank you for listening. That was Developed Market Public Debt, A Long Road Ahead. For future insights, please follow us on your favorite podcast platform. Macro Signposts highlights weekly takeaways from the data analysis conducted by our team of economists and other macro experts. For PIMCO's official views on the global economy, please visit PIMCO.com. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need, and it is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcast may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.